Hi, and welcome to this edition of the Insurance Experts. It's my pleasure to have on the line Lisa Ramsay. Lisa is unique because she's a financial planner in Canada, and so I'm excited to hear from her insights on the Canadian marketplace versus the US marketplace. Thanks for joining us today.
Thanks for having me, Mark.
So, you're a holistic financial planner, and I know you also specialize in insurance solutions. So, how did you get into this industry in the first place?
Well, I got into this industry because I wanted to do full cycle planning with my clients. So it was watching people go through things that I was going through with my husband. His oldest daughter, my stepdaughter, has a disability, and watching others struggle with the same sort of financial issues, it was a gap that I wanted to really learn about and help fill.
Wow, it's really commendable. And being in the long-term care planning space, of course, we see a lot of these types of things all the time. So, I think that personal stories really motivate people the most to do this, right?
It
So,
helps because you're there to fulfill it with others, right?
yeah. So, tell us a little bit more about your practice. I know you go through almost like a consultative approach with your clients. What does that typically look like when they start to work with you?
We sit down and we talk about where they're at now in the short, medium, and long term, where they want to be in the short, medium, and long term, and how to get there. Really, what their goals and dreams are at each stage. So, everyone's idea of going on a trip is different. Everyone's idea of retirement is different. So, we really sit down and try to find out where they're at. What does life look like at age 75 or age 85? And then sort of trickle backwards and see if everybody's on board with the same concepts and ideas, and then bring that forward to them.
And I'm sure you uncover a lot of surprises, especially when you're working probably with a married couple, if their goals or their dreams don't align quite in sync, right?
Absolutely. Sometimes we do what we call the envelope surprises, where if we're sitting in the meeting and they're not agreeing, I get them to go home and write down what their version of retirement is and seal them in envelopes and bring them back to the next meeting where I can open them. And then we have a little bit of marriage counseling.
That's an awesome technique. I'm going to steal that one from you. That's really cool. So talk about kind of the long-term care side, just because that's where my background is. I'm curious about long-term care in Canada versus the US. Do you find a lot of people are planning for this need? Or is the government funding any of it? How does that look in general?
The government funds a little bit of it. You'll get subsidies to get into government subsidized housing, I guess, for homes.
Mm-hmm.
It's not where I would want to send a relative, nor would I want myself to be. But we have a pay to play, which is private or the government subsidized.
Mm-hmm.
It's not something most Canadians will favor, although they don't understand what they'll end up with if they don't.
Mm-hmm. Right. Very similar to the US in that regard.
Mm-hmm. In Canada, it's more along the lines of looking at disability coverage when you're looking at going from short-term disability to a long-term disability, maybe to a long-term care facility where you can say, I want this much money over this much time, and you can purchase the policy, right? Mm-hmm. Or you can purchase, say, a critical illness policy with a rider to convert to long-term care if you've never claimed for critical illness. Mm-hmm. But I really feel that Canadians as a whole, less than 3% of Canadians have correct insurance in Canada, whether that's permanent or whether that's temporary insurance or even critical illness or disability. As we get into the more intimate insurances, like the critical illness, the disability, and the long-term care, that 3% shrinks down to less than 1%. And really, Canadians out there that end up in a home either end up subsidizing it themselves or mm-hmm. end up in a government facility where the care is good care. Don't get me wrong. The nurses are great and they do their mm-hmm. job, but the facility itself is not what, say, we would have wanted initially.
It's not funded as well. That's the bottom line. The resources aren't
exactly.
there. And I kind of have the same question. I know a lot of people out in the audience want to hear about how estate planning and retirement planning might differ in Canada versus the US. And so you were telling me a little bit about the provincial structure. Can you talk a little bit about that?
Well, in Canada, each province is unique and separate and apart from each other, even though we are a national unified country. But what happens is, for example, in Alberta, we have probate, and it doesn't matter what size your estate is. It could be 10 million, or it could be 100 million, or it could be $10,000, or it could be $5. If it goes through probate, it's a single cost, somewhere around $450 plus tax. In other provinces, it can be more than that. It can be less than that. For example, Ontario has a sliding scale with a percentage of your estate, which can maximize out somewhere around 70%.
Wow. That's a big difference, $450 versus 70% of your estate.
Yeah, but it depends how you've planned for it, right?
Right.
And where you pass away. The other problem we have in Canada, well, I wouldn't call it a problem, but another issue we have in Canada, or challenge, is that if I'm in Alberta and my parents live in Ontario and they pass away and I'm an executor, I have to post a bond of approximately $40,000 so that I can handle the estate because I'm out of province.
Interesting. So, in the US, obviously we have different state variations, but it's not exactly the same as the different provincial variations that you described. So I know that you had worked with a client recently, and it was kind of a unique situation. Tell us a little bit about the client you had worked with as they were planning for retirement a little bit later than average.
A client who's come to me that is in their early 60s, married couple, lovely people, and they hadn't saved. They'd been self-employed their whole life, but hadn't been putting money aside for retirement, and thought, well, we better do it. We want to retire soon. So we looked at where they're at, what their goals and dreams are, and we looked not at using wealth as the sole purpose for retirement savings, but we looked at the risk management side, and we looked at using long-term care, critical illness for a portion of it, some permanent insurance, some term insurance, and of course the savings aspect through permanent tax shelters so that we could grow their wealth faster and freer of tax.
Right. I think a lot of people assume if they don't plan early in life that it's kind of they're done for, but it really is never too late to form a plan, either financially or for long-term care or what have you.
Oh, exactly. You may not get what you thought you were going to have. We can't all save and have $10 million in 5 years. We're not Warren Buffett. But there is a solution out there, and we can find it to work within your budgetary needs and your lifestyle, for sure.
Well, as we kind of wrap this up, if you had to give one tip for somebody about, moving to Canada, let's say, and they're thinking about retirement, what would the tip be for somebody in the US who's thinking about doing that?
Know what assets you have in America and know what you want to leave there and what you want to bring to Canada, very specifically because of tax on the wealth.
Okay. And so what you mean is that there are certain things taxed here that are taxed in Canada differently. What would be one example of that?
Well, if you come to Canada and you buy a property, it's taxed very differently here than it is in the US. We don't get to write off our mortgages on our income tax, whereas you do in the States. Our property tax on our homes isn't portable from home to home. Very different. Capital gains are treated very differently in Canada right now. So know what assets you can leave in the US that will be in a tax advantage position versus what you're going to have to do with taxes when you bring it to Canada. And of course, we can help with that, but it's good to know your IRA versus your 401k versus...
Right.
Right.
Very cool. Well, thanks for that tip, and thanks for joining us today on the show, and we hope to have you on future episodes.
Thanks, Mark.